Hey, welcome to Mortgage Minute for March 15th. As always, there's lots going on in the market. First and foremost, want to let you know, March 17th, St. Patty's Day, we're going to see an increase. The Irish present from our French Prime Minister is going to be an increase in your CMHC insurance premiums. As of March 17th, CMHC and Genworth are increasing premiums on mortgage loan insurance. Higher premiums impact homeowners with insured mortgage of a loan to value greater than 65%. So unless you're putting 35% down, you're going to be facing higher insurance premiums. If you'd like to send me an email, I can send you a list of what those new insurance premiums are going to be. In the meantime, talking about interest rates, watch for the Fed in the United States. That's the American version of our central bank, the Bank of Canada. Janet Yellen is the chairman of the American Fed, and they control the interest rates on the U.S. side. So look for an increase in interest rates. So what does that mean to you as a Canadian? Well, one thing, if you're an investor, regardless if you're a real estate investor, if you're into stocks and bonds or RSPs, pay close attention to this, because a U.S. Fed rate will have an immediate impact on the Canadian dollar and bond yields. So there'll be an impact on bond yields. There'll be an impact on a lot of types of products that Canadians are investing in. For example, a typical financial planner will have, a 60-40 weighting, 60% equities, 40% bonds. Mark my words, if we start to see an increase in interest rates south of the border, your bonds are going to take a beating. This is the time you need to have active management of your investment portfolio. Just another example here the other day, dividend investors, beware of the rising bonds. There's a lot of people in their stock portfolios are sitting there saying, oh, I'm perfectly fine, I've got dividends in there and that's all good. And the concern here is that a lot of people are either managing their money themselves, or they're passively being involved or invested in mutual funds, etc., etc. But unless you have an active management on that portfolio, you could be susceptible to a sharp increase in interest rates. And we're going to see that, again, not on your mortgage rates here in Canada, but on the U.S. Fed rates. And this was an interesting article. The biggest threat to investors is not the Fed. I won't go into details on this. It was a bit of a side, just a nice small little article in this morning's paper on the side here. If you get a chance, it's a report on business, March 15th. Basically said Miss Yellen, the chair of the U.S. Fed, is universally expected to bump up the United States' key interest rates. If so, some analysts fear that the higher payouts of bonds and savings accounts could undermine the Wall Street's long-running bull market. So here's the other flip side of this. We've seen an unprecedented run in the bull market. The bull market, the stock market in the U.S. and Canada, has gone on an upward trend of over 8 years. It is the second longest running bull market in history. So I'm not saying that means it's going to crash or correct, but logic would dictate, you might want to start looking for some defensive strategies. For example here, Shiller, if you may recall, Robert Shiller wrote a couple, he's an economist, and he's written a lot of best-selling books, etc., etc. But he basically has an article here saying kind of a dot-com deja vu. In other words, he's looking at, the hype that went around the dot-coms, which led to the dot-bombs, and he's seeing a similar hype around the Donald Trump effect. And he goes, why are traders so fixated on the upsides of the Trump presidency when the downside risks seem to be so obvious? For example, confrontational foreign policy, haphazard management style have bred to uncertainty. So if there's a lot of uncertainty as to what's going to happen with the U.S. with Trump's presidency, if you will, we absolutely know that the markets are really rallying right now, and there's a big surge and support behind the Donald Trump presidency. And I'm not being political here, but again, logic would dictate we're only a few dumb moves away, and I'm not saying, what are the odds Donald Trump's going to do something crazy, eh? So we're only a few crazy moves away from a total correction in the stock market. So what's the point I'm trying to get at here? now is the time to have a defensive strategy. Now is the time to revisit your portfolio. And what can we learn from watching the Smart Money? Here's a great, if you get a chance, send me an email. I'll send this to you. It was written by Thanes Center. It was a breakdown of the Tiger 21 group, which is the 21 most wealthy individuals here in Canada, and basically says, where are they putting their money? Well, 30% of their money is going into direct ownership in real estate, 21% into public equities, 21% into private equity. And folks, that is the market where I think the least amount of education knowledge is about of how to take advantage of private equity. 21% of the money that the Tiger 21 group is spending is going into private equity. Might be something you want to consider, because typically 100% of Canadians' RSP money is in stocks and bonds and mutual funds. So take a look at where you're at today, analyze it, and that's really what it's all about here. I'd like to offer you, more so now than ever before, it's important to take the time to analyze how you're managing your real estate, your portfolio of stocks and bonds, and are you including at least 20% private equity? If not, we should have a talk. Ladies and gentlemen, that is your Mortgage Minute for this week, and we will be bringing you, we'll be going back to doing webinars shortly. You'll be getting more information on the upcoming webinars shortly, but that's the Mortgage Minute for this week. Send me an email, and let's do a portfolio review. Wishing you all the best for the week. Have a great one. Thanks.